Is Philip Plotch, and I'm the principal researcher here at the Eno Center for Transportation. Welcome to the latest in our series of webinars. Eno is an independent, nonpartisan, and nonprofit think tank that shapes public debate on multimodal transportation issues. Today, we're going behind the scenes to learn about transportation financing and debt. Government agencies and their private partners need to borrow money for all types of transportation projects, whether it's building bridges, expanding airports, fixing up subway stations, or modernizing seaports. Today, I'm delighted to have four very smart and insightful people talk about this subject. Scott Tromer is the Senior Vice President at WSP Advisory Services. Scott Monroe is the Senior Director at Fitch Ratings. Baye Larsen, Vice President at Moody's Investors Services. And Caitlin Devitt is a Senior Reporter at The Bond Buyer. Whenever you want, you can enter questions in the Q&A box on the side of your screen, and we'll get to as many of those questions as possible after our guests introduce themselves. You should know that Eno is happy to offer our webinar series free of charge. If you're interested in supporting our important work, check out the link in the chat box to donate or become a member. And with that, let's start with Scott Tromer.
Thanks, Phil. Appreciate the opportunity to be here today. I'm going to focus my remarks on a overview of transportation funding and needs. So U.S. transportation infrastructure needs are vast. Each year, across all modes, governments spend about $400 billion to improve and expand our infrastructure. And even at that amount, according to the American Society of Civil Engineers, that's about half of the needs required to bring this overall system to a state of good repair. Over 60% of expenditures is for highways, which is not surprising, given our travel needs dependency on good roads, followed by public transit at 18%, airports at 14%, and the balance for ports and seaports. Now, in terms of funding, recognizing the importance of the federal government, federal grants represent about 70% of funding, while state and local resources make up the difference. By mode, the mix of funding varies between federal and state local resources. Highways and transit are more dependent upon federal funding, while self-supporting assets such as airports, ports, and toll roads, rely more heavily on their own user fee revenues devised or derived from user fees, charges, and tolls. But back to the point of the importance of federal funding, passage about 2 years ago or 3 years ago at this point of the bipartisan infrastructure law, which it provides about $1 trillion in new funding over the next over the 5-year period in ending in 2026. Provides a generational increase in funding and holds a promise to help transportation agencies meet their state of good repair needs, and also provide additional funding to support the expansion of intercity passenger rail, public transportation, electric vehicles, and other federal priorities. But even with this tremendous increase in funding, the industry has faced significant cost increases due to higher labor and material prices in the aftermath of COVID, and to extent that made it impede progress on dealing with the backlog. And the other issue has been, although funding commitments started off slowly as the program was stood up, there has been more progress in recent years, and significant funding commitments are being made, with over 54% of federal funds being obligated and about 25% distributed to grantees. Now, while federal grants represent an important element of funding for the nation's transportation needs, state and local revenues and user fees also represent a critical component. By mode, highways rely more on a basket of dedicated taxes, including gas taxes. Transit agencies receive money from sources ranging from state and local appropriations, and dedicated funding like sales taxes and fare revenues. As I noted earlier, airports, ports, and toll roads, rely on their own source revenues through user fees and charges. And all these agencies, utilize their state, local, and user fee revenues and leverage them to issue bonds to, finance their capital needs. And at this point, there's roughly about $512 billion of transportation debt outstanding. About half of it is for highways, 20% is for airports, and the remaining balance is divided almost evenly between toll roads and transit. This debt has been traditionally issued in the tax-exempt markets for investors, including mutual funds and individual investors. But at the same time, transportation agencies have been seeking private financing through the use of public-private partnerships to help, use an avenue to deliver projects in a more timely and potentially cost-efficient manner. Given the significant backlog of needs facing transportation providers, we expect, even with increased federal support, that agencies will continue to rely on their own source revenues and continue to issue debt to finance their growing capital needs. Now, with this overview, I'd like to turn over the presentation to my colleague Scott Monroe, who will talk about the particulars of the credit implications for the various types of debt that transportation agencies issue. Scott?
Thank you,
Scott,
Scott.
before you go, I just wanted to say
Oh,
one
sure.
thing. There were a couple of questions about the presentations. There are no slides. Each of our esteemed panelists is going to talk for about 4 minutes or so, and then we'll do Q&A. All right. Thank you, Scott. And thank you, Scott.
Thank you. So I'd like to take this opportunity to go over two major items. One is to give you a sense of what our Fitch economists are projecting for this year and next. And I wanted to go over that because it has such a significant impact on transportation credit. And then secondly, I'd like to share with you Fitch Ratings' outlook on the big three transportation classes that my sector rates, which are airports, toll roads, and ports. So let's first talk about the economy. And here, I have generally some pretty positive news. Our economists are not forecasting a recession, which is a bit of a shift from the prior stance. What they are projecting, though, is some fairly slow GDP growth over the next 2 years. Think about 1 to 1.5% growth in 24 and 25. Now, GDP growth does tend to be a big driver of transportation volumes. And so what this suggests is that transport volumes are likely to be stable, yet kind of growing at a low pace over the next couple of years. On the inflation front, we're seeing some good news. After a few years of very high inflation, that has come down significantly. Last year, we came down to inflation rate about 3.5% from 6.5% the year before that. And this year, our economists are projecting inflation is going to fall even further to about 2.6%, just above that Fed target rate of 2%. It's going to fall a little bit more next year. So that's going to provide relief to transportation agencies in terms of O&M growth, which has been running at high levels. It's also going to provide some relief in terms of construction costs. And then with the more favorable inflationary environment, this is going to give the Federal Reserve room finally to start lowering interest rates. So our currently the Fed funds rate is at 5.5%. Our economists are projecting that's going to fall about 75 basis points by the end of this year, and it's going to fall even further next year to just 3.5%. So what we're expecting to see is that when transportation agencies go out into the marketplace, they may be able to do so at more affordable rates, and it's going to increase the opportunity for more economic refunding activity. So the general takeaway of the economy, we're seeing it generally trend in a positive direction that will promote stability for a lot of transportation agencies, yet in a fairly low growth environment. So that's the economy. Let's talk about the transportation outlooks. And we just released a transportation outlook piece last month, which is available on our website. Our outlook for all three sectors, so toll roads, airports, and seaports, are all neutral. And what that suggests is we don't think that those ratings are likely en masse to move up or down. Most of our rating actions are likely to be affirmations of existing ratings. And that neutral sector outlook is really driven by a few things. One is the stable economic environment, which I already mentioned. Another is that volumes are largely recovered to pre-pandemic levels. And that's not true of every transportation agency. but it is true of the majority. The most are at or near or above 2019 levels. So the recovery, by and large, has already occurred. And then when we look at the capex and the debt plan side of things, we are seeing some diverging trends, but nothing that's keeping me up late at night worrying. And just to go through what we're seeing in terms of airports, it is the airport sector where we're seeing the biggest capex projects, along with the largest debt issuance plans. But there's some mitigating factors to that. Things like new airline use and lease agreements are putting into place, and some of these have higher liquidity levels in anticipation of higher debt to offset some of that burden. The agreements tend to be based on a cost recovery framework. The airlines anticipate to kick in more money. Most airport debt is fixed rate amortizing, so it's rolling off as new debt is coming online. And then because most of the debt is being used to fund expansion of capacity, it's expected you're going to have higher parking revenues, concessions, and other things, so that net leverage is going to remain fairly stable. So we're not too concerned about the airport sector. In toll roads, we see kind of two main buckets in terms of who's issuing. You have the mature systems like the Northeastern Turnpikes, largely maintenance-driven capex and debt issuance plans. As what we're seeing largely is as debt is rolling off, new debt is rolling on. So we're not really seeing a trend towards significantly higher net leverage. And then in growth-related capex, we're seeing in states like Florida and Georgia. But to the extent that that debt is being used to create new revenue-generating assets, whether it's a conventional toll road or a managed lane, oftentimes the new debt is offset by a new revenue source. Lastly, there's the port sector. This is where we're seeing relatively speaking, the smallest capital plans, the least amount of debt issuances, and they tend to be these funding needs that tend to be met using pay-as-you-go resources as well as grants. Capacity seems adequate coming out of the COVID era, where consumer spending is rotating out of goods back into services. And actually, we expect net leverage for a number of our ports to fall over the next 5 years. So, broad takeaway: economy is sound but not stellar. Transportation sector is stable, and we are expecting gross debt to rise moving forward. But due to various mitigating factors, we see net leverage as being pretty stable. And I'd be happy to address any questions in our Q&A section. And now I'm going to pass the baton over to Baye Larsen with Moody's.
Thank you, Scott. So I am Baye Larsen. I am a senior credit officer at Moody's Investor Service. And I'm going to talk briefly about our transit outlook, since that'll wrap up the kind of transportation forward look that Scott just started, and then a little bit about what rating agencies do and what our role is in the transportation financing market. So at Moody's, our outlook for transit agencies for 2024 is negative, which is different than what Scott was describing for the other three sectors of airports, ports, and toll roads. The key reason for that difference is because transits have not seen the kind of recovery in ridership volumes that other transportation sectors have seen. So I think probably 4 of the 5 screens of us presenters here, we are in some office that is not our company office. People are working from home, and people are doing more online. People have not gone back to mass transit the way that we've gone back to highways, airports, and other enterprises. So fortunately, this has not had as big an impact on transit finances as you would expect, because transits benefit from a lot of tax support and government subsidy. So most of transit revenues, probably about 85%, really come from tax dollars and other government appropriations, and only on average about 15% come from the fares collected when people get on buses and subways. The exception to that are our largest transit operators like New York MTA, Chicago, Philadelphia a little bit, where the more kind of urban, high concentration neighborhood that's being served, the more likely they are to receive a large share of their revenues from fares. But even then, maybe 35-40% of their total revenues are coming from fares. So low ridership, we're mostly seeing, maybe about 65 to 70% of pre-COVID levels for most systems. That is not affecting budgets in and of itself, but as much because of federal stimulus and those taxes. But that's leading to our negative outlook because the ridership does serve as a proxy for that system's importance to its city and local economic area. And if there's fewer riders and the government partners view that transit system as potentially less essential to the local economy, then there is some risk that those subsidies and tax dollars will receive less political and public support going forward. And those subsidies are critical for transits to continue operating at the level that they're at and to continue to support the capital projects that they need to fund. Transits are generally in a period of transition right now, both in terms of what their funding sources are, but also in identifying and reprioritizing their projects going forward. So we have not seen as much transit borrowing in the last couple of years because revenues are low, usage is low. There's not as many reasons to borrow, and there's not as much money to support the borrowing. But we do expect that that's going to change going forward once transit systems nail down kind of what the new funding structure is going to look like. So for example, we've seen with New York MTA, they received significant new dollars in the last state budget that increased one of their largest tax subsidies, and they are doing much more borrowing against that new revenue stream than they did pre-COVID. So that's our outlook on the transit sector in general. It is very different from our other transportation sectors. And then to get a little bit into our role as a rating agency, I think we have a unique position that I personally enjoy of being able to look both at kind of the public view of a transportation agency, and then also be able to look behind the curtain a little bit, if you will, and have direct communications with issuers, direct email exchanges, hear management strategy firsthand. And that's a critical dynamic for us in providing an assessment of that transportation agency's ability and willingness to repay its debt. And that's really what our ratings represent. We're looking at competitive position, finances, debt, management policies, and rolling that all up into an assessment that we represent with a rating. And our ratings cover we have a 16 rating range, but most of our transportation agencies really fall into the top 10 ratings, which we call the investment grade ratings. And so the highest of that is your AAA, where our US sovereign is AAA, 18 of our 50 states in the US are rated AAA. And then kind of going down in buckets, we have the AA rating range, single A ratings, BAA ratings, and below that, we get into our below investment grade rating range. Some of our transportation agencies, for example, like New York MTA, is rated A3, so kind of right in the middle of that investment grade group. But a lot of other highways, toll roads can be rated, higher than that because they have sort of a broader, more stable set of revenues. So I think that covers my key highlights, but again, I'm happy to take questions at the end, and I will pass it over to Caitlin.
Thank you. So I'm going to focus a little bit on the market side and then talk a few minutes about some of the challenges facing transportation debt going forward. On the market side for investors who are a mix of as Scott mentioned, kind of mom and pop buyers looking to take advantage of the tax exemption, and institutional buyers like insurance companies and banks and big firms like BlackRock and PIMCO. The key question is what pledge backs their bonds. So that's what revenue is the government or the state or the transportation agency going to use to pay off its debt. And what investors want to see is permanent, recurring revenue, stable, predictable revenue that insulates them from volatility. So to take an example of what Baye was just talking about with public transit space, there's this, much dreaded fiscal cliff that we're talking about and the low ridership. But for a lot of investors, they're looking kind of past that to what backs their bonds, which is not fares, almost overwhelmingly not fares. It's taxes, sales taxes, other taxes. And so it's not to say that they're not concerned with some of the challenges facing the operating budgets of transit companies, but more that they're looking past it and they're not fearing like imminent default or weakness in payment. The other thing for investors that's real important is politics. Transportation debt is a subsector of the municipal bond market, and as such, it operates at the intersection of finance and politics. So political decisions are very important, and lawmakers, state, local, federal, are making decisions on tax rates and toll rates and public-private partnerships and new toll roads. So again, what investors want to see here is they like to see independence from the transportation issuer, that they can maybe raise some rates without going to the state lawmakers, and some flexibility and general sort of insulation from politicians. So I wanted to talk for 1 minute about a recent bond deal to sort of talk about some ratings and affect prices. The New York State Thruway Authority came to market a couple weeks ago with $1 billion worth of revenue bonds. This is one of the biggest tollway systems in the U.S. And they have a few different bond programs backed by different pledges, including the personal income tax, New York State personal income tax. But these are revenue bonds backed by tolls as well as some other revenues. In September, the authority okayed a series of toll increases through 2027 to help finance a $2.4 billion capital plan over the same period, I think. And which, by the way, prompted a Republican state senator to introduce a bill to dissolve the authority. And it's not expected to go anywhere, but it's sort of an example of that political risk. And so when they came to market, they touted these toll increases and, saying it was going to stabilize their financial position, increase debt service coverage. They won some positive rating actions, and upgrade and a positive outlook. And so the deal was pretty well received. I mean, when you come to market, there's a lot of factors at play. It's not just the credit. There's a lot of technical factors, but it did pretty well. It's the authorities rated single A plus. So when it priced the 30-year bonds, yielded 3.95. And that same day, the 30-year AAA bond was yielding 3.56. So that's, 40 basis points difference, which doesn't sound like much, but compounded over 30 years, it can be a lot of money. So in the last few years, transportation debt, as other panelists said, has been down. That's true with muni issuance in general. It's been down. This is even though states have been increasing some of their transportation investment. They just haven't been using debt as much. But most market participants think this is going to start coming up. And if we see interest rates come down, for example, and airports have a lot of needs, 151 billion over the next 5 years by some estimates, about half of that for terminals. You also have Scott Drummer was talking about the bipartisan infrastructure law. We're going to be at the halfway mark. We're going to start seeing a lot of projects there. Locals might come to finance their piece of that. There's a bunch of mega projects happening, Gateway, Brent Spence Bridge in Kentucky and Ohio. You have some high-speed rail projects that are real high profile that are going to be hitting the market. And on the transit side, there's needs there. And I wanted to take a minute to talk about the MTA. We've talked about it a little bit, but it dominates the space. The public transit debt market is estimated around 80 billion. MTA has $44 billion worth of debt outstanding, so more than half that market. It's one of the biggest issuers in the muni market as a whole. And so they've got this congestion plan program coming up, if it survives the court battles, which I'm sure everybody's familiar with, charging drivers to enter Manhattan south of 60th Street, I think. And so this is a big deal. A lot of cities are watching it. LA, Seattle, Boston, even Illinois talked about it. So they're going to be watching to see how successful it is, if they can get it. And investors are looking at it because it's going to be a new type of debt. And it's going to be a new revenue pledge, a new bond. And so one thing they're going to be looking at right away is how it performs, how the actual revenues are coming in versus budgeted or projected revenues. And I think the MTA now is saying they expect about $1 billion a year. That might be not the latest, but $1 billion a year to leverage about $15 billion. So, and then on the operating side, as we talked about earlier, they won fresh support from New York State. A lot of other transit agencies want the same thing, Chicago, in Washington, D.C., and a lot of states are looking at that. So they're talking about revamping some of the revenues, again, to shore up sort of on the operating side, which would also help the debt side. And for highways, roads, and bridges, the big question is what's going to happen with the gas tax, which has been the key revenue transportation infrastructure source for a long time, and as we all know, has diminishing purchasing power. So a lot of states are starting to look at this. Massachusetts governor just appointed a task force. Hawaii just did an interesting thing where they're mandating road user charge. Not for a while, I think it's 2033, but that'll be the first mandate. So we're going to start figuring out how to charge EVs. Tennessee just approved, they became the latest for public-private partnerships. They're going to use that to build managed lanes. For dedicated toll lanes for that revenue. So these are all going to be so states are starting to look at ways to kind of increase transportation funding for capital projects outside of the gas tax. And investors are going to be looking at that too, to see what type of new revenue pledges are going to emerge as the transportation system as a whole undergoes this transition. And that's what I got. So I'll send it back to you, Phil.
Great. Thank you, Caitlin. Caitlin, you just answered two of the questions that I saw up here.
Okay, good.
One of the questions I have here is, are transit agency finance personnel sophisticated enough to understand and address the risks of debt instruments, especially innovative finance techniques? That came from a State Department of Transportation person. Anybody want to handle that question? If you think that the transit agencies are sophisticated enough to understand all of this?
I mean, I'll start with some, sorry, Scott, I'll start with some comments on that and then people can
sure.
add detail. My first reaction to that is, like in all things, it takes a village. So there are always a number of advisors and participants in developing financing plans for large projects. I think that most of the transit systems that need innovative financing to support large projects probably do have the sophistication to understand the pros and cons of the debt instruments available to them. And to the extent that they're launching into new territory, for example, in states where maybe they've only just allowed P3s with new legislation, there is a learning curve, but there is a deep bench of advisors and market participants who can help bring them up to speed.
Yeah, I would
How
agree
about
with Baye's point.
Okay. How about elected officials when they sort of make that determination on that money needs to be borrowed? Do you think they have a good understanding of the risks that are involved and what it all means?
I think it's probably a similar answer to the one that Baye already provided. And if you went to an elected official at any given point in time and you asked about what are the mechanics of variable rate debt, or how does the P3 structure work, and these type of things, they might not have a great answer, but faced with a decision to make, usually there's an expert finance staff. There are third-party advisors, financial advisors, bankers, and other people who are involved in that process, who provide the information that those policymakers need in a digestible way. To cause them to become informed to make the right decision. So I think the answer is yes at the time when the decision is made.
Okay.
Yeah, I would also add to that.
that.
Sorry, I have a lag, which is making this complicated.
Oh.
Sorry.
Okay.
I was
Go
just going to add that I think different states have different appetites for borrowing and debt. And maybe we see that more at the state level rather than at the transportation agency level. But some states have a strict no debt policy for transportation. They want to just pay for all of it with current tax revenues coming in that year. They don't want to borrow for it. Other states are more open. And of course, some of that culture, it can be have political origins. Some of it can have need origins. If you're a rapidly growing state and there are a lot of transportation demands, it's harder to say no to debt than if you are a more rural, slower growing state where it's easier to afford those investments year to year.
Okay, thanks. So Scott Monroe mentioned inflation, how it's coming down, and gave the numbers. And the question was, has anybody thought here about the inflation specific to highway and bridge construction? Because this is certainly going to affect the ability for agencies to complete their projects.
Sure, I can start on that. I think as I mentioned earlier in my commentary, that even with increased federal funding, transportation agencies are facing a challenge of dealing with increasing project costs, across all sectors, not only just for highways and bridges, and that can affect the amount of debt that they need to raise. Some of that debt is being offset by increased, federal funding. But on the other side of the equation is, in terms of costing projects, engineering firms, transportation agencies, are taking a much more conservative stance in terms of cost estimating to, deal with the inflation that we've experienced over the past several years. I've been having some conversation with rail car builders, and everybody recognizes the high rate of inflation, but echoing Scott Monroe's sentiment, the rate of inflation is expected to come down, and that's been feedback we've been getting from some suppliers.
Yeah, and there are indices that address these. So
Yeah.
the Federal Reserve publishes one that addresses
Right,
just construction materials, and those costs have been coming down since the middle of 2022. There's other overall construction indices that address just nationwide construction costs, and those indices skyrocketed in 21 and 22. But since then, they've been falling roughly in line with the inflation rate. And the problem for anyone today who's about to embark on a construction project is just because the rate of inflation is slowing, it doesn't take construction costs back to what they were in 2019. You still have this huge multi-year increase. And so it may be cold comfort to say inflation is coming down because you're still faced with very high costs compared to if you embarked on that same project half a decade ago.
So another next question we had was, what could a
And
transit
politically, I would
agency...
also
Go ahead, Caitlin.
Oh, I'm sorry. I was just going to add. I was just going to add that politically, it's difficult too, because you see some huge increases in numbers, especially if they haven't necessarily updated the financial picture for a project in a couple of years. Then all of a sudden, you're seeing a huge number, and you're going to bring out a lot more opponents in it. So it's really been, since the IIJ's come out, it's the inflation for the construction costs has really posed a big obstacle for a lot of people who've wanted to move forward with some of these projects.
So we talked about the challenges that transit agencies are facing. So one of the questions was, what can transit agencies do to improve their credit rating? Anybody want to take a shot at that one?
Well, I can start on that. Working with transit systems, and also being a former credit analyst and financial advisor. So transit agencies are pretty highly rated. They're typically in the A or double A category, and a lot a lot of the rating is based off of the strength of the revenues pledged, the stability of it, debt, things like debt service coverage. So investors are protected from a lot of the financial pressures that occur after the payment of debt service. That being said, and as Baye noted, rating agencies do worry about how transit agencies are managing their costs, dealing with lower than expected ridership. I think it all comes to dealing with the fiscal realities of for a period of time ridership is not going to be back to pre-COVID levels. We're at the 70% mark, and so transit agencies need to adjust their services and their cost structure to deal with this new environment, but at the same time also working with their funding partners to secure new funding to help bridge the gap. And as Baye noted, MTA has secured additional funding. BART has, and looks like SEPTA in Philadelphia and Pittsburgh Regional Transit will through legislation, but there's still a number of transit agencies that face significant pressures, like Washington Metropolitan Area Transit Authority. So it's both to improve their fiscal condition and to improve their outlook by the rating agencies. It's a matter of managing both their costs and the service that they provided, as well as the revenues that they're securing from their funding partners.
Anybody else want to add anything to that?
Yeah, I would add to that transit issuers have the benefit of the really the tax support from their parent governments, and some even have the authority to levy their own sales taxes or to go to voters for sales taxes, and that gives them the option to issue different types of debt. And debt that is repaid or backed by taxes is generally higher rated than debt that is repaid by fare revenues, because that tax revenue stream is insulated from the operating risk of the transit system, and is generally more stable, more has a better growth profile than the fare revenues, which even pre-COVID, we saw a long, slow, steady decline in transit fares. So while transits have a lot of the sort of budget pressures, and it'll be a difficult road for them to really improve their financial flexibility over the next few years, as Scott was describing, they do have the option to leverage these tax revenues if their structure, if their financial structure allows that, and that would get them, typically to a higher rated bond than a fare-backed bond.
So Caitlin mentioned something about how rating agencies, they look to see the ability of a government agency or a transportation authority to pay back the bonds. Have any government agencies not paid back those bonds? And does that, if one government agency defaults on its bonds, does it affect everybody else because investors start to get scared?
Yeah, I can say just at a very high level, there
I'm
have been very, very few defaults in the municipal debt market, and those that have occurred are, now very famous. We see Puerto Rico, we see Detroit. They're largely at the kind of higher governmental level. And within transit agencies specifically, there is really no history, at least in the Moody's rated universe, of a transit default.
Hmm.
Sounds like Caitlin was going to add to that.
Yeah.
Yeah, I was just going to say, I mean, there really haven't been, as you know, the muni market is famous for that, for the low default rate. There have been a couple, and I'm not, maybe somebody else knows this, a couple the toll roads that have gone bankrupt in Texas a while ago. I'm not even sure if they ever defaulted though. You have like the Indiana toll road, which is privatized, that they even switched ownership and never missed a debt payment. So it's really it's very rare. If it did happen, it would definitely have repercussions on other issuers.
So there's a question here. This is an interesting question. If the federal, this is from the US DOT also, if the federal government starts to provide federal funding for operations of transit systems, would that introduce more risk given the annual appropriations required? If it introduces more risk, would that be counterproductive to the debt ratings? So it's an interesting question, that idea that the federal government could help subsidize operations for transit agencies, but if the local agencies start relying upon it, then that might be adding to the risk. I don't know if anybody have you ever thought about it, but let's see if we have a good answer here.
Yeah, uh, I think, well, to a certain extent, transit agencies do, even larger transit agencies do use a portion of, their federal capital funds for a special element of operations called capitalized maintenance. And that definition could be flexible. Smaller transit agencies can use their federal funds for operations. Now, clearly, if there's that the ability to use federal funds for operations broadens, considerations include, well, is there sufficient federal funds for that system to also use for its capital improvement program, maintain its assets in a state of good repair. uh, there's always the worry about delayed appropriations, but while there's been some federal shutdowns, it hasn't largely impacted the highway trust fund and the mass transit account. So there's a well-established mechanism for those funds to be flowing. So I mean, I think in short, if there's a level of reliable support, continue ongoing reliable support from the federal government, that's an integral part to the transit agency's operation. I think it is neutral to helpful.
Mm.
I would agree with that assessment. So all other things
There is
held equal, we would still be talking about an increase in revenues. And there could be delays, but the vast majority of governmental entities are holding on to significant reserve levels. So let's say they're a 30, 60, 90, even 180-day delay. Presumably they could lean into reserves, whether that's unrestricted cash balances, a debt service reserve account, or some other structural feature to bridge that gap, or even if they had to do some kind of very short-term borrowing or something along those lines. There's also other ways to mitigate risks of delay. It could be that the timing of when debt is paid as compared to the anticipated receipt of the federal revenues and so forth. So I think I acknowledge that there's always the risk of an appropriations delay. But if we're talking about an additive revenue stream, which, by the way, for a transit agency is not likely to be the primary revenue stream, I would think that we would look at that positively.
Thanks. So Caitlin, I want to ask you the last question, and if you could explain the question before you answer it, that would be very helpful. So, do you expect any impact on borrowing costs for issuers given the contraction ongoing in the municipal bond banking industry? Both Citi and UBS have exited in the last year.
Yeah, so Citi and UBS, Citi, a major player, kind of famously is in the top 10 of senior managers for debt, exited public finance amid their big restructuring. Um, that the new CEO is doing a restructuring. They announced in December they're leaving. So that's a big deal. And then UBS also announced they're leaving they announced in October. So I think it remains to be seen. A lot of people think that a lot of the regional firms are going to be able to step up. And there's a lot of talent out there. There's all those bankers that are out there now looking for jobs. A lot of them have landed already. So there's a lot of regional firms that are picking up some of that talent. And then there's also the Wall Street firms. And by the way, those exits are kind of, as I was talking about earlier, issuance being down, transportation debt and other muni issuance. It was sort of a result of some of that. There was a lot of kind of compression on spreads and fees. And so there was a lot of competition. And that was part of the reason. So the question was, is it going to have an impact on transportation debt issuance going forward?
Yeah.
Was that the question, Phil?
Yes.
I mean, I think it remains to be seen. In short, I don't think so. I mean, I think that the market is, is kind of reverberating a little bit from Citi's exit in particular, but I think that it's going to remain strong. And there's a lot of those bankers are going to land at different places. They already are. And they're going to be calling on the calling on the transportation agencies, as they always have, and pitching their ideas. And I think that, as interest rates come down, that's going to ease up. Financing costs are going to go down, and they're going to still continue to come to market.
Okay. Well, first, I just want to say thanks. This was wonderful. Exactly what I was hoping for when we started this. A lot of insight, a lot of knowledge, and I think we've shared some really important information with the audience today. You can find a recording of the webinar on our website, enotrans.org, and the recording will also be emailed to everybody who registered. Make sure to sign up for our mailing list. You can gain access to Eno Transportation Weekly, webinar announcements, report releases, and more. And we're happy to offer our webinar series free of charge. If you enjoy them, check out the link in the chat box. You can think about donating or becoming an Eno member. I'm also excited about our next webinar. It's on February 21st. It's called Shifting Gears Toward a New Way of Thinking About Transportation. Thank you again, and have a wonderful day.